Yo, what's going on, everybody? It is Tuesday, July 12th. Like pulling teeth. Remember I said that last week? That's what this market action is like, folks. Very choppy and frustrating, and that is because we no longer have the fiscal environment that we had last year and, in the pandemic year of 2020. Where there were just massive fiscal flows month after month and the market just got pumped way up. So we're kind of like back to the olden days when it was like a normal flow, and we are adjusting from, like I said, very strong fiscal environment last year to a more moderate one right now. Yesterday, actually, and I think I mentioned this in the video, I suspected that yesterday we had a net liquidity drain just based on the fact that the market was struggling to stay positive. I think we closed mixed yesterday, I don't recall. And indeed, that was the case. We had a 7.2 billion net drain. When I talk about a net drain, I mean taxes exceeding the spending flows yesterday by 7.2 billion. So that brought the deficit for July down to like 82 billion. Still decent, but like I've been telling you guys, we still have not made up for the April tax draw, and we need another 95 billion to make up for that. And we'll get close to it next month because August we're going to have that quarterly interest payment. But it's been rough. I mean, we're basically dealing with an environment where we have seen a fiscal liquidity drain. So what's happening is that the economy is adjusting to that. We have good positive bank credit expansion, and that's good. I would say that is keeping the economy from even a deeper recession. I'm pretty sure we're going to see a negative print for a second quarter GDP. Earnings coming out this week. I saw Pepsi early this morning. The earnings were good. Thursday, I think I mentioned this yesterday. Thursday we got JP Morgan and Morgan Stanley. Friday we got Citigroup and Wells Fargo, I believe. And Monday we have Goldman Sachs and Bank of America. I talked about this yesterday. I'm interested to see, and it's still early. I should mention it's still early with respect to bank earnings and interest payments by the Fed. Remember, as the Fed raises interest rates, that obliges the Fed to pay more money into the economy, and a lot of that goes to the banks on their reserve balances. Today, the euro, here it's interesting, it hit exactly, I watched it this morning, get down to one bid. It may have been bid just slightly below one. I did not see a bid below one. I saw it trade at $1 exactly. Almost looked to me like there may have been some intervention. I don't know if there was, but quite possibly could have been the ECB protecting that psychologically important $1 US figure. It's going to go down below there. Like I said yesterday, policy right now it's just not bullish for the euro. I mean, what's happening with the energy situation, Germany flipping from a current account surplus into a current account deficit, the economy slowing down. I mean, it's just not bullish for the euro. And if the ECB tries to defend the euro by raising interest rates, it's just going to exacerbate the problem. I don't know if there was any intervention. It just seemed, that's a big psychological number. It takes me back to my days as a floor trader. I can remember vividly, times when there was some big important psychological number in the market. And we'd get up there, or it would fall down to that level, and it would bounce off numerous times, just because that was a focus. and you had orders massed at that level, and it took time, but eventually it would break through either on the upside or on the downside. But again, I don't know if the ECB was active at 1. I think if they were, it probably would have been reported in some of these FX sites. I didn't see anything like that, so it might have just been, you know, kind of like occurring organically. That's a big number, 1. But again, I see it going below there, and ultimately, I see it going down to 82. 82 is where it was in 2000. Now, I believe the euro started to physically trade in 2000. It started to trade electronically prior to that, but it started to physically trade in 2000. We did go down. I think it came out initially like around 117 US dollar, and then it traded all the way down to 82, and then it rallied all the way up to around 160. I think that was maybe could have been like in 2004, 2005, maybe a little bit later than that. So it's been all over the map. But now policy, eurozone policy, I think is just the euro's going to go down. I mean, I don't see anything bullish in the policy right now. They have a severe energy situation. You know, as fall and winter approaches, I think that's just going to exacerbate the trade balance, the deficit there, and that's just going to weigh on the euro. And there's not a lot that the ECB can do at this point. All right, so we have that, and that is a concern. That is a concern for U.S. markets. It's a concern for earnings. Again, that all factors into trade balance, U.S. dollar strength. Usually increases the U.S. trade deficit, which results in that income outflow. As I talk about, that's a subtraction to GDP. Somebody asked me today, hey Mike, why is the dollar going up? Well, the dollar, to me, you know, you always have the safe haven argument, but to me, the U.S. now is a net exporter of petroleum. I think that's very important. And the other thing to remember, and this might sound counterintuitive, but if we are really in an era of de-dollarization, where, you know, the rest of the world, they understand the risk of holding U.S. dollars in the sense that if you are not aligned politically, foreign policy-wise with the United States, you could be shut out of the global dollar-based financial system. You know, we see that with the sanctions on Russia and secondary sanctions and sanctions on Venezuela, sanctions everywhere. That the only way the rest of the world can rid itself of dollars is to exchange those dollars for goods and services in the United States. In other words, if one country divests of dollars, let's say what Russia did between 2014 and like 2021, a complete divestiture of dollars, you know, but the dollars are sold in FX, in the foreign exchange market, and some other, it just gets transferred to some other country, let's say Ireland or the UK or the Cayman Islands or something like that. That is not a divestiture. That's just a change of ownership. The only way the world in the aggregate can reduce its holdings of US dollars is to exchange them, like give it back to the United States. And how do you do that? By buying goods and services produced in the United States. Number one right now being energy, being oil and fuels. We see that the US is a net exporter. And the other way is capital investment. I mean, we're starting to see some increase in capital investment on the part of foreign entities, foreign firms setting up shop in the United States, and I think this is a nascent trend. It's the beginning of a trend, and so this is the irony here is that I think a lot of people believe that, oh, de-dollarization, you know, that's going to be bearish. In fact, it's not, because what happens is that exchange dollars, they give us back the dollars for goods and services. That narrows the trade deficit and the current account deficit. It starts to shrink that. And that's bullish. And I think that's what's going on. And that's like, right now, I would say that's like a secular trend. That's just getting started. So whatever you think about the dollar in terms of, Fed print money and all this other stuff and interest rates, I mean, this supersedes that, because this is a secular, global trend. This trend of de-dollarization, like sending the dollars back to the United States in exchange for, well, right now, basically petroleum and petroleum products and capital investment. And speaking of capital investment, and I think I mentioned this yesterday, if you look at the bank data, to me it says that personal consumption and business investment is still strong. So I said that when we see second quarter GDP, and almost 100% certain it'll be a negative print, it's going to come from the subtraction through the trade deficit and also the reduction in government spending, both at the federal and the local and state level, not from personal consumption and business investment. I don't think, anyway. I mean, the bank trends just seem to suggest that to me. So yeah, we had a fiscal drain yesterday. Tomorrow is a Social Security payment, and that should be supportive, but unfortunately 2 days of drain, yesterday and today, that Social Security payment tomorrow, I don't think is going to be enough to offset, the 2 days of drain. So we're gonna still bounce around here. I think the market is still vulnerable to some short-term selling. And again, overall, I wish I can give you more definitive, hey, we're going to go straight up. But I mean, I said this already going back a couple of weeks. It's going to be choppy. It's going to be a slow rise into mid-September. We're back in an environment where you got to trade these swings, or you just have to be patient. And when the market pulls back, you could nibble, you could accumulate, and hold it. Oh, let me mention oil. We saw a big drop in oil today, about over an 8% decline. As a matter of fact, we've got the API inventories, which just came out a short while ago, showing like almost a 4.5 million. I think it was like a 4.5 million build in inventories, crude inventories, gasoline inventories were up, distillate inventories were up. I gotta say, technically, it looks weak. This is no doubt speculative long liquidation, but at the same time, I have to say that the backwardation in the oil market, in other words, the premium of the front month contracts over the deferred, I mean, that's still very steep. And, it did pull back the last couple of days, but I mean, it's still a very large premium in the front month. And that reflects, I think, tightness in the physical oil space. And eventually, unless that thing really collapses, and I don't see that happening, it still looks to me like a buying opportunity. Tomorrow, Biden is heading over to the Middle East. He's going to meet with MBS with Saudi Arabia. I mean, that might be something that, maybe there's some inside trading going on. Maybe somebody knows that the Saudis will agree to, Biden's request for more oil. I don't know. That could be happening too. I have, no personal information on that. I'm just saying, like, this sell-off kind of coinciding with Biden going over there, it's something to pay attention to. Anyway, that's it for today, folks. Enjoy. See you tomorrow. Bye.